Stocks in the red across the board, as you know. NASDAQ falling below its 200-day moving average. That for the first time since March. My next guest expects even more downside ahead for stocks going into the end of the year. Let's bring in Sonia Meskin of BNY Mellon Investment Management. Nice to see you out here. So what's going to take us lower? Why are we going to go lower?
You know, we really thought the stocks were priced to perfection a month or so ago. And it seems, you know, with the term premium rising, with the economy doing very, very well, sometimes the good news turn out to be bad news for stocks. This seems to be one of those examples.
Is a fallout in tech going to be the straw that breaks the camel's back, as they say, and that's going to start us on that road lower?
Potentially for stocks, yes. Not necessarily for the broader economy. We do think part of the reason the term premium is rising is actually because the economy is doing quite well. I mean, of course, another reason could be the fiscal situation. And it is an unusual time that we're having a very strong labor market and a lot of fiscal stimulus in the system.
When do we look at good economic data like we got today as just an undoubted good, and we're not worried about anything but the fact that GDP is so strong, employment's still good, and that's ultimately what matters more than anything else? When do we focus on that?
That is an excellent question, but unfortunately in the late cycle stages, which is likely where we find ourselves now, this is probably not the case. Once rates have truly declined on the policy side, at least, that's probably where we start looking at, you know, good news as good news. But that could happen for reasons that are not necessarily that auspicious at the start, such as a recession.
What happens at the Fed meeting in November where most people, including the market, expects nothing?
Well, in fact, I think they've communicated very well that they're not going to do very much. Their guidance for December and for next year will be important because that tension between strong data, stronger than they have been expecting, and the fact that they're pausing, they're saying because financial conditions have tightened, in part because of the rise in rates across the curve. But they're still pausing in face of strong data. That tension is going to remain. What are they going to do in 2024? Is it going to be high for longer? Is it going to be potentially a hike or two more? That is still an open question.
What do we do with the issue, since we're talking about rates, the fact that many would suggest there's just better value, better risk reward in the bond market still than there is in the stock market? And that dynamic is not necessarily going to change anytime soon.
Yes, this is our expectation as well, especially for the strong corporates with strong balance sheets that can withstand higher rates, that are benefiting from the strong consumer, strong labor market. This is where we think the value lies.
Yeah. What kind of target do you have on the S&P? We saw where we are today. We're below 4,200. Seems to be, sort of a critical, if you will, line in the sand in some respects. Where do we go between the end of the year, now and the end of the year, when all the hopes were on a year-end rally?
Yeah. Well, we actually are a bit less sanguine on equities. We don't expect a lot of downside. We think around 4,000 for the S&P that's our central expectation. That said, important to emphasize, there is quite a bit of uncertainty around that view, even internally for us, and even more so in 2024.
All right. It's good to see you. Thanks for coming out here.